Welcome everyone to this explainer. Okay, today we are looking at a heavily backtested, pure price action trading strategy that has been run through the ringer literally thousands of times. If you're tired of staring at a screen completely cluttered with confusing indicators, lagging moving averages, and chaotic patterns, well, you're in the right place. We're going to completely ditch all that noise today and just focus on pure price action. By the end of this explainer, you're going to see exactly how this straightforward, calculated approach can completely transform the way you look at a chart.
Okay, let's dive into this. Here is our roadmap for today. First up, validating true market structure. Second, supply and demand zones. Third, minimum risk to reward ratio. And finally, we're covering a mind-blowing bonus, the stop-loss entry trick.
Before we get too deep into the weeds here, I want to briefly establish these three non-negotiable pillars. Step 1, market structure. Step 2, supply and demand. And Step 3, risk to reward. This is a very strict sequential formula. And I gotta warn you right now, if you even slightly mess up the very first step, you will ruin the entire strategy. You just can't jump to Step 2 without completely mastering Step 1. So let's make sure we have that foundation locked in tight.
Section 1. Validating true market structure. Let's get into it.
You know, one of the very first things you learn as a trader is the basic concept of uptrends and downtrends. I mean, it's the sippy cup of trading, right? Higher highs, higher lows. But this basic concept is actually where the vast majority of traders make fatal mistakes. Let's talk about the illusion of the fake reversal. Imagine a super common scenario. A chart is making higher highs and higher lows in a very clear uptrend. But then, suddenly the chart takes a dip and breaks right through a recent low. Instantly, panic sets in. A massive wave of traders assume a downtrend reversal has begun, so they immediately start looking for short trades, betting the price is going to just keep dropping lower.
But here is what's really interesting. Notice the clear distinction between the invalid low on the left and the valid low on the right. That panic scenario I just described, that chart is actually still fundamentally bullish. Why? Because that recent broken low was an invalid low. Here is the golden rule. Write this down. A low is absolutely meaningless unless it previously broke the highest point of the trend. If the price dipped, came up, but failed to break the previous high, that low point is totally invalid.
We really need to drill these anchor rules in because they are absolutely crucial. They are the secret to this entire first step. A low must break the previous high to be validated. Therefore, if the market breaks an invalid low, it does not mean you're in a downtrend. You are still fundamentally bullish. You should only be looking for long positions as long as the last true valid low holds. The market can go sideways, up, or down, but until that validated low is broken, you are in an uptrend. Look, if you don't understand this, the rest of the strategy completely falls apart.
Moving right along to Section 2, supply and demand zones.
Now that we know how to properly validate the market trend, let's find the precise areas where the market will react. Let's look at the demand zone. Demand zones take place strictly in uptrends. When you see an uptrend, you are looking for an area of consolidation, a point where the price moves sideways for a moment, right before a massive, sharp impulse move upwards. That sharp move tells us that a massive amount of buying interest ticked in right at that specific price. To mark this, you just grab your rectangle tool on your chart and draw a box from the low to the high of the consolidation candle right before that market explosion. Boom! That is your demand zone.
Now, a supply zone, that's the exact opposite. This takes place exclusively in a validated downtrend. You look for a sideways consolidation right before a violent, actually scratch that, it doesn't just have to be violent. It just needs to be a very sharp, clear move downward. That drop indicates heavy selling pressure. We draw our zone the exact same way, marking the candle just before the drop. Because we saw a large downward move originate here, we wait patiently for the price to retest these exact areas, assuming that historic selling pressure will step in once again.
So let's walk through how this builds our execution mechanics inside these zones. First, confirm the trend using our valid structure rules. If you're in an uptrend, you only look for demand zones. Because let's face it, shorting in an uptrend is just silly. Once you identify that consolidation before the impulse, you do nothing. You literally just wait. You let the price come back and re-enter your drawn zone. That is your entry point. You set your stop loss just outside the zone, and you target the recent highs if you're buying, or recent lows if you're selling. Backtesting shows you can often catch consecutive, highly accurate winning trades just by waiting for price to re-enter these freshly created zones.
All right, Section 3, minimum risk to reward ratio. Listen, You might perfectly identify a valid uptrend and draw a gorgeous demand zone, but without this final safety net, the trade is totally worthless. The absolutely crucial point here is this massive number, 2.5 to 1. This is where discipline really separates the pros from the amateurs. If your setup yields a ratio anything below 2.5 to 1, you completely walk away. You do not take the trade, no matter how good the setup looks, for sure.
Let's mathematically break down why, because it's super straightforward. If you're risking $100 on your stop loss, your target profit must be at least $250. Demanding this 2.5 ratio drastically increases your long-term profit rate because it ensures your winners heavily outsize your losers. It acts like a shield, protecting you from mediocre setups where the reward just doesn't justify the risk. You only ever pull the trigger when the math is undeniably in your favor.
And now for the plot twist. Section 4, the stop-loss entry trick.
We're shifting gears from the core formula to a brilliant psychological tactic that exploits impatient traders. Read this exact, highly counterintuitive quote from our source material. Put an order in to buy it at where you're going to put your stop loss. Let that sink in for a second. This is a total paradigm shift. Most traders enter a trade and put their stop loss right below the obvious recent low. This trick asks you to wait and actually place your buy entry order exactly where everyone else is placing their stop loss. No way, right?
But this tactic brilliantly illustrates how the market really moves behind the scenes. Remember in step 1 when we talked about the illusion of the fake reversal? When an invalid low is broken, the masses think it's a break of structure to the downside. They panic sell or their stop losses get triggered. The big market makers know this. So instead of buying early and getting stopped out with the crowd, you identify that obvious low where all the stop losses are sitting. You place your buy entry right at that exact stop loss level. You literally capitalize on the trap, entering right as the majority of the market is getting stopped out in panic. I seriously encourage you to test this phenomenon yourself. Don't risk real money yet. Just write it down. Next time you see a setup, grab a piece of paper. Write down exactly where you normally would have bought and where you normally would have put your stop loss. Then, just sit back and watch. Watch how many times the market goes exactly to your original stop loss order, sweeping that liquidity before rocketing off to your original target. It is going to blow your mind.
So we've covered validating true structure, waiting for supply and demand zones, strictly enforcing a 2.5 risk to reward, and exploiting the stop loss trick. So I'll leave you with this provocative thought as we wrap up this explainer. Knowing how the majority of traders fall for the fake reversal trap, are you going to keep trading the illusion? Are you finally ready to ditch the fake outs and trade the true underlying structure? Thanks so much for joining me on this explainer, and I can't wait to explore more fascinating concepts with you next time.